Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. All right, so this week, once again, we've been getting mixed metaphors from a lot of the retailers. And it seems like either the retailers are knocking it out of the park or they're completely falling flat on their face. And we mentioned on Wednesday's show that we were going to take a peek at Dollar General, which was a darling after COVID, had a nice big run up. But recently, their numbers have just been flat out scary. The stock has given up all the gains since COVID. And on Thursday morning, they announced their quarterly earnings and effectively after the announcement went down about 12%, and they're down a little bit today. So we mentioned the fact that it would be a breakout to the downside if we did get some bad numbers, and they just basically missed. Their guidance also was poor after the miss on the earnings reports, and that has happened with a few of the other stocks. All the stocks that are weak are blaming the consumer. All the stocks that are strong are rewarding the consumer, saying that we like Lululemon announced earnings too, and they've done very well. The stock is up solid today. Also gave solid guidance. They have the same type of expectations on sales going forward. So very, very odd to me what's going on with that consumer, but it is still holding the market in place. We had jobs numbers that came out, and they were kind of right in the middle, kind of something that the Fed was looking for. And after the jobs number, we actually saw the probability, according to the Fed Funds Watch over at the CME, the Chicago Mercantile Exchange, actually go down. And we've seen that play out in the 10-year. The 10-year yield, which was, I guess, the biggest concern in August, because we are now in September, it's September 1st, was the fact that we saw the 10-year breaching the 4.3% level and hanging around that and slowly creeping higher. Now we see the 10-year down at 4.18, and it actually dipped below 4.1% for a second. And that's just showing you that the economy is starting to believe the fact that the Fed later on in the month, it's at the end of the month around the September 20th date, that later in the month, the Fed will not be looking to raise interest rates, that they're going to just take a pass this time around. The probability last week was about a 20% chance that they would raise the Fed funds rate by 0.25%. Now we're all the way down to about a 10% chance. So a lot does a 1 week of data make. And once again, just mixed metaphors as far as the retail earnings. We've got a lot of retail earnings over the last couple of weeks. And yeah, that's where we're at in the marketplace. We're in September. Seasonally, this is one of the worst months of the years, going all the way back to 1950. If you looked at the rate of return in September, it's actually a negative number. Not by much, but it's a negative number. And also October is a negative number when you go all the way back. Almost, I think, every other month on the calendar has a positive number. But one of the big things to remember about September and October is it's mainly because of when it seems like whenever we have a market crash, it always has occurred in those months. And those market crashes have really skewed the overall performance of September and October. We looked at the VIX chart in the middle of August, talking about how volatility usually increases as we get into September and October. And guess what? We're actually back to the July lows in the VIX. The VIX right now is trading at 1329. So this is not held true so far about the seasonality of the VIX, which would mean that markets are usually down. We're just starting September. So it's too early to call, but usually we see the VIX trade at higher levels throughout September and October until we get into the holiday shopping season, and then you see some volatility drop off. Not the case right now. And obviously I say that only because usually the volatility is considered the fear index. The reason why September and October obviously are months that the marketplace, and there's really no rhyme or reason to it, but the marketplace usually underperforms. So it would make sense that the VIX is usually higher, because in down markets, volatility increases, mainly because people need to buy options for protection, which increases volatility, and hence the reason why the VIX will increase in price, because it's based off of the 30-day implied volatility, or it's a moving average on the 30-day implied volatility of the S&P 500 index option contracts. So when people come in and buy puts as protection, it drives up the VIX, and hence the name, the fear index. All right. So we were going to get negative going into September on the S&P 500 index, and we did have a down day. The downside is that when we put on the trade, as soon as we put on the trade, the market kind of rallied into the close. Then on Thursday, the markets actually came off a little bit, but they didn't come off enough not to offset that rally. And as we see right now, let's go to the option grid in the TradeHawk software. And as we see the SPX right now, we are actually up a fraction, but we are up. And we had a very short-term trade. So we're still above the 4,500 level. We were hoping that it would break down below the 4,500 level and continue down, and hopefully that was just like a support level on the downside. And if we could have broke through it, then maybe we'd go down and hit the levels inside our butterfly. So here's the trade that we put on. We went in on Wednesday at noon Eastern time on Options Guide TV, and we put in this paper trade where we came out and we bought the 44.90 put, sold 2 of the 44.70 puts, and bought 1 of the 44.50 puts, which I am highlighting on the bottom half of the TradeHawk software inside the order ticket. At that point in time, that butterfly was trading for $2.10. We were hoping it would come within the range. We had about a 40-point range in the butterfly, obviously, from 44.90 down to 44.50, but we needed about a 0.5% move to the downside to make this thing look profitable. 1% move would have been a very solid outcome for the butterfly that we had on. Now, I mentioned an adjustment, and we talked a lot about the adjustment on Wednesday's show. If you want to go back and look at it, what the adjustment is, it takes some capital to do it, because you're going to be rolling into a couple of put spreads, short put spreads, but you're doing that into a market that's rallying. So that's the concept that's behind this here. So I have to come up with some capital, even though I'm going to do this for a net credit, but I do have margin requirements that would happen. So right now, the trade is kind of past us. If you were going to do that roll, you would have did it on Thursday before the close. We are now on Friday. It is now September 1st. Markets are, well, I'd call them almost flat from when we put on that initial trade. Actually, we can even take a quick peek at it if you want to. Let's go in here. Got my Dollar General up, but let's look at the SPX and zoom in a little bit here. All righty. Okay, so Wednesday, we were the 30th to the 28th, 29th, 30th. So here's basically where the market was at. And so we've had a couple of days where it closed down on the low end of the candle. We had a positive day on Wednesday. Like I said, we ran into the markets where we rallied a little bit all day Thursday. I think this is the 30th. I can't see down on the bottom there. And then we get into today, which should be today's candle. And we see we're at 45.15, 45.13. Okay. So we've kind of been flat just a little bit. The marketplace trying to decide decent jobs numbers. Well, let's put it this way. We're in the scenario where bad news is good news. Jobs numbers didn't scare anybody. They were kind of right down the middle. Probably pretty good for the Fed, because you really don't want jobs to totally go away, but you just don't want us to be knocking it out of the park each and every report, which has happened the last few reports as far as the job numbers are concerned. We still have unemployment at low levels, but it's increasing a little bit. 3.6%, I think, is where the unemployment numbers came in at. And so solid numbers. Nothing in that report was available to really scare the Fed. And obviously, we saw a drop off in the probability of the Fed increasing rates by 0.25% at the September meeting at the end of the month. All right, so how would I adjust this trade? Even though I probably wouldn't do it right now, I would have done it on the close. And on Wednesday, what we talked about is we're going to roll into a short put spread. So I'm going to try to say this slowly. And if you have any questions, please feel free to put them in the chat box. We'll try to address them at some point in time in the show. If you're on YouTube, you can do that. And we can comment and we can try to answer any questions that you may have, because this is a difficult topic. And we like to make this a very interactive show here on Options Guy TV. All right, so I have my butterfly on. Basically, what I'm going to do is I'm going to sell the most expensive option contract and buy the cheapest option contract. So the option contract that you'd be selling here on our trade, and the strikes are highlighted because they're down inside the order ticket, is the 44.90 strike. The index is at 45.15. We'd be selling this $1.30 option contract. Now, remember, we paid $2.10 for it, so that's not a good thing. We want to sell. We would like to sell this option contract one of those maybe around $4 or $5 in that scenario. Oh, 1 second. And then, so we'd want to do that right around that $4.50 to $5, somewhere in that range is when we'd want to do that trade. And that was late in the day on Thursday. We now see that's trading for $1.40. And this is part of the reason why I wouldn't do it, because I'm bringing in risk onto this trade. I'm going to add a lot of risk to it, but I'm not getting enough bang for my buck for doing it. But I still want to talk about how I would have adjusted this trade on Thursday. So we'd sell this option contract, and that would leave us with two short 44.70s. Can't be short two of them because we only own one of the 44.50s. So that's going to make us naked short a put in the 44.70 strike. So how do we protect that? We sell it. We buy another 44.50, the cheapest option contract. And now what we've done is we brought in a net credit to help offset our initial debit on the trade, lower our overall risk. But we're going to need some capital to do that because we're now going to be into a short put spread. And if we did it this morning or right now, you're going to be in that short put spread for half a day, right? The market's closed today, and these option contracts will stop trading. And we have an up marketplace. So part of the rationale behind this is that you got to, you're looking at Thursday, you got a positive market that's starting to go up. We're going to adjust the trade into the market rally, and we're going to go from a bearish trade into a neutral. From a bearish trade into a neutral to bullish trade on it. So how would I do this? So let's pretend that this is our position in our account, right? What I would have to do then is I'd have to go out and close this option contract. So this would be a sell to close, which it won't allow me to do that because I don't have that position on in this test account. But I would sell to close, and then here I would buy to open, and I would add another option contract onto it. So I'm going to do that just by adding one here, and then this would go away, and that would be your ultimate position. I would be short 2 of the SPX 20-point wide, so they're $2,000 is the requirement. This would be a $4,000 requirement. So I'd have to have this money in the account before I did the trade. And I would have limited risk, but now I'm bringing in a net credit to the account that's going to offset the initial net debit that I put on the butterfly. So if I look at this trade, let's go back and remove this strike. And let's add a sell here. And so we're going to sell the 44.90, and we're going to buy the 44.50, which is cheap because the market's really gone that direction. So right now we can do this for a credit of $1.18. So it's not bad. It was a little worse earlier. The market was up, actually. I think it was up 0.5% or so. So the number was a little worse. So if we did it now, we're bringing in a credit at that moment of $1.18 if we filled at the midpoint. We paid $2.10 for the initial butterfly on Wednesday. You bring in $1.18 net credit. You're now at now you have 92 cents is your net debit for the entire trade. Our risk profile has changed a lot because now we're short 2 put spreads that are 20 points wide. But with that said, we have now put this entire trade on, and our total, if the stock stays where it's at, instead of losing $2.10, we're going to lose 92 cents. So hence the reason that if I put on this trade and I'm going to take this risk on of being in 2 short put spreads, I want to get something for it, right? So we see that this is a net credit of $1.18. If I'm looking at this, I'm not necessarily even looking at where the SPX is at. I'm looking what this roll is at, what this spread would be. Where this would be, remember, a sell to close, and this would be a buy to open. And if that midpoint gets down to about, gosh, if I paid $2.10 for it, I would say at $4 would be my least amount that I would want it to get down to. I'd rather get it at $5. If you go to Wednesday's show and you watch the video, it was initially at $8. So somewhere between $4 and $5. Then I actually get a decent profit on a trade that has gone awry. But I also have added a lot of risk for a very short-term trade, right? Because we only had 1 day. We would have did this trade. We would have did the roll on Thursday. We would have all day Friday for that to happen. All right. So if you have any questions, feel free to put them in the chat box. And yeah. So that's that simple. So let me go to the what if calculator, because this is one of my favorite things to do as far as hedging and adjusting trades. If I'm long a call spread or a put spread, I like to look at the possibility of selling a spread along with that position to make that trade a butterfly, or even a skip strike butterfly, or even an iron condor at some point in time. If I am long a butterfly, I a lot of times like to look at what's the probability of rolling it into a credit spread, or a short put spread, a short call spread, all the same thing, and potentially bring in a net credit to offset my risk, or offset, I should say, my debit on my butterfly. So I like to roll in and out of butterflies and long spreads to try to adjust a trade. Now, a big thing about adjustments, and I think this is the most important thing, at some point in time, you got to just give up. And on a very short-term trade, I'm only going to adjust it once, and that's going to be it. And I'll know where that adjustment point is at. Like I said, I was valuing this adjustment off of where that spread was trading, spread that we were just looking at. So here's the way that the trade worked. Here's the long butterfly. So I have 2 what-if graphs going on here inside the Trade Hawk software. So we did the butterfly. The market was right about here, 4,515. It might have been a little bit lower than that. And we were hoping the market would come down and breach that 4,500 level and trade somewhere close to 4,470. And that would be our maximum upside. We had a 20-point wide butterfly. That also means on a 1x2x1 basis, the most that you could make would be that $2,000. That wasn't our goal on the trade. We would have got out earlier than try to hit a home run on it. But with that said, that's what the upside was. Now we went in and we adjusted it, right? We added 45.50 and we sold the 44.90. We did not touch that middle strike, the 44.70. We didn't touch that at all. So now if I run over here and I look at the long butterfly, or I look at the adjustment, now this is what the trade looks like, right? So we got rid of this option contract and we rolled into the short put spread. Now we have $4,000 worth of risk, but the market's at 45.15, and our hurt point is now 44.70. So a fairly large move that it's going to have to make. Let's do it on a percentage basis. So 45.15, and I do see we have a question. I'll try to address that here shortly. 45.15 minus 44.70. That's 45 points. That's about 1% divided by 4,500. We're about 1%. So by the end of the day, you would need a 1% move to the downside to touch your short strike. And if it did, I would close the trade. I mean, you don't want to mess with it at all if these option contracts get in the money. So I would just close it out and say, okay, I'd made my adjustment and I was wrong again. I'm going to take my comeuppance and I'm going to close out this trade and move on to another trade. And that's totally the way that I would play this. And so if I ever want to get bearish on the market, like just going into September, and that's part of the reason why we're looking at it. Once again, you know, we're trading at a specific time here on Options Guy TV, but they are paper trades. And this was a learning experience because the market did go against us. And this is how I would have adjusted this trade. Very straightforward. So let's see, I got a couple of questions here, actually. So the first one, let's pop that one up on the screen. As you modify this trade and your risk and margins change, how do you calculate your total return on this trade? I guess I would calculate my total return based off of what the adjustment would be. I have to have that $4,000 in margin or in cash in my account to begin the trade. Even though I'm paying $210 for the initial butterfly. So my capital requirement, if I made the adjustment, is $4,000, and I would base that whatever return I would make on it. Let's say that we sold the butterfly. Let's say we made $3. That would have been a great number, even though you could have sold it for 20, right? Let's say we sold it for 5, which would be $500. So you would take 3 divided by 4,000, and your rate of return would be just about 1% on that income that you're looking at, a little less. But that's how I would look at my rate of return over that 2-day period or however that trade was entered. And then the follow-up question just says, meaning the return on investment. So it's totally fine. Yeah, that's exactly how I would approach it. You have to look at the capital that you have set aside for the trade, not what you did on the initial trade. So if I don't have the capital to make the adjustment, I probably want to put this trade on. That's straight. Being straightforward with the trade. Now, there's a different adjustment that I could do if I had that would take a smaller requirement. We'll save that for a different day. But what that would basically mean is you are you would have to adjust quicker, and you're going to sell the most expensive option contract and then buy back one of the shorts. So you're basically just rolling into one short put spread. But that's just not as enticing. So normally I'll do it the way that we adjusted it here, but it's all about the capital requirement and the total risk that you're willing to take. All right, so that's the SPX trade. If you have any other questions, you can bring them back up here just a little bit later on. Now I'm going to go and look at a trade for Friday. Why not? We talked about the potential. Just basically, we were at a precipice on the Dollar Tree chart. So I think I'll run back to the software and we'll look at Dollar Tree. I keep saying Dollar Tree. Dollar General. We'll look at Dollar General. So right in this range here, let me zoom in around the earnings, which was Thursday morning. Oops, escape here. Okay, so this is where we were sitting going into earnings, right around this range. We talked a little bit about what's going on in the chart. We had a lot of noise on the chart overall. And then what happened here, let me readjust this chart. Let's go in and do this. Let's go there. And there we go. Okay. So once we had the down day in the underlying on Dollar General, let's see where we're trading today right now. We were down on the open. I don't want that momentum to drag in. Okay, so we are still down. We're down another 5%. Wow, that's really getting beat up. We're down right around 130 on this. My chart's not updated. 1 second. Well, all right. I guess we're going to punt on the chart. So my chart's not updating, and I'll have to figure that out a little bit later on. So if I look at this trade in Dollar General, and we see that the market right now is down 130 from when we initially put on. When we initially looked at that trade, it's down. I think if I'm going to do the math in my head, it was down about 12% yesterday. So now we're down about 17%. And I would have wanted to do this on the open, just because we did have the breakdown on the chart. So how would have I got long? And let's look at getting long a put option right now. I'm actually going to do a long put spread, and I'm just going to try to build the momentum just on the short term on this long put spread. So I'm going to go out 14 days because we do see the chart. I want to give myself enough time. And when you're doing a long put spread, the timing is so important because you're buying an option contract that wants the market to go down, but you're selling one that wants it to go up. So in order for that put spread to max out, you need some time decay on that option contract that you're selling. So you need that to wither away as the underlying stock starts going down towards that put. You need that time decay to wither away. And hence, once that does, that allows the spread to maximize if you're correct on your forecast. So I'm going to look at this trade right now. I'm going to straddle the market is what my plan would be here. So I need the September 15th. There we go. 14 days away. Dollar General is now at 130. Gosh, when I looked at it, the initial trade that I was looking at, it was at 135. So it's really started to drop. Now I'm going to, it was 130. 133 is where the market was at when I was looking at the trade. 131.11. It's not as interesting. All right. I guess I'll just do a out of the money. I was going to do a 5-point wide one and starting with the 135 and selling the 130. Now we've already moved down to that range. So dealing with live markets. Yeah, we'll do it this way. We'll speculate this way. We're going to buy the 130s. So I'm going to adjust my trade. So let's clear out our SPX adjustment. And we are going to come in and we're going to buy the 130s. And we're just going to go 5 points wide. So short-term trade. We're going out 14 days. Make sure I got the right expiration. And we're going to sell the 125s. I wanted to be a little bit in the money on the long strike. I really wish to more so straddle the market, but we don't have a 132.50, right? We don't have that 2.5 point strike on this expiration date. We don't have 1 point strikes. So we're stuck with 5 point strikes. And that's part of an issue sometimes when you're trading with option contracts is this is a less liquid stock than you would see in the SPY, Apple, NVIDIA. So they just don't have as many strikes available. And that is a good thing because it usually makes the markets a little bit tighter. But it's frustrating because I can't map the strategy exactly the way I want to do it. So we're going to adjust it up. We're going to buy the 130. We're going to sell the 120. Our risk is going to be a little bit lower than I first intended, but that trade would already been profitable, honestly. So we're 5 points wide. The midpoint, we're going to call it 130. And that will be the official paper trade for this show of Options Guy TV, and we're running a little long here. So 5 minus 130 equals 370. So 5 points wide, we're paying 130 for this trade. The maximum is 5, meaning 5 minus 130 means our upside is $3.70. We've got a couple of weeks for this to play out. Probably going to go a week or so, and if the market were to bounce and come off of this 20% downturn almost in Dollar General, well, I would probably get out in a week or so. If it's going with me, I might ride it a little longer, but I don't want the time decay to totally kill me. So if I saw this, I'm paying $1.30 for it. A lot of times I'll use half the value of that as my out point. $1.60, 65 cents, 60 cents, somewhere in that range, I would consider getting out on this spread. All right. One to highlight USO. Interesting enough. We did a trade on USO. We did a fancy trade. We sold a put spread to buy an out of the money call. We bought the 77 strike out of the money call. Guess what? We went out to September 1st and we just missed. So we had 20 cents of total risk on that trade. And it doesn't look like we're going to get to the 77. So we're going to probably be out that 20 cents. So we'll just leave it there. Sorry, I'm a little long-winded today. Oh, gosh, I got one last question. Let's go and look at that one last question, and then we'll call it a week, and we'll hopefully enjoy the weekend. What determines the point difference between the strikes? Is it the distance to the expiration that winds or narrows the points between strikes? Okay, so what determines the strikes? Why are they 5 points wide? First of all, the first thing is that we're looking at what the price of the underlying stock is. You're not going to have 5 point strikes if it's a $20 stock because it's too big of a percentage. So the more expensive the option contract, the more expensive the strikes can be. Second of all, if you are looking at the volume, so if a stock can support a lot of volume in the option contracts, then you're going to see tighter strikes. Like, for example, the SPY index is a much more expensive underlying, and we have 1 point strikes in them, much more expensive than the USO or any other underlying that we've been talking about. It's $450, but if I pull up the SPY chain, you'll see that we have 1 point strikes in the SPY. Well, volume supports it. So they offer up the 1 point strikes, which makes it easier to trade the SPY index. Dollar General just doesn't have as much volume, and it's a $130 stock. So they have determined on this expiration, which is a normal expiration, that they're going to only have 5 point strikes, and it's that simple. All right. That's going to be it for this edition of Options Guy TV. Thanks for coming. Please click subscribe, ring the bell, pound that thumbs up. That helps us out here on the show. And we'll see you this Monday for the next edition of Options Guy TV. Thanks for coming, everyone.